The Federal Reserve, which is America's central banking system, is tasked with a dual mandate of accomplishing maximum employment and maintaining price stability. This two-part mandate implies that the Federal Reserve has been given the responsibility to foster conditions that will enable as many individuals as possible to find employment, and also to keep the prices of goods and services at a level that doesn't fluctuate too much. This means that the Federal Reserve is tasked to conduct monetary policy to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. The methods that the Federal Reserve uses to achieve these objectives involve the utilization of various monetary policy tools. These tools include mechanisms such as setting interest rates and the strategic purchase of government securities. By manipulating these tools, the Federal Reserve can exert control over the inflation rate and stimulate economic growth. Interest rates, in particular, are a powerful tool at the disposal of the Federal Reserve. By adjusting these rates, the central bank can influence borrowing costs. Lower interest rates make it cheaper to borrow money, prompting businesses to invest and consumers to spend, thus stimulating economic growth. Conversely, higher interest rates make borrowing more expensive, curbing excessive spending and helping to keep inflation in check. Government securities, on the other hand, are essentially loans that the government takes from investors. When the Federal Reserve purchases these securities, it injects money into the economy, encouraging spending. When it sells these securities, it pulls money out of the economy, helping dampen inflation. Looking back at the US economic history, we can observe periods of low inflation over the past few years. This low inflation environment has been largely due to the Federal Reserve's success in managing inflation through the use of the aforementioned monetary policy tools. However, recent economic trends and data suggest that inflation has picked up pace after 2020. The reasons behind such inflationary spike include factors such as increased government spending, a recovering economy, and supply chain disruptions. The inflationary spike after 2020 led to a tightening of monetary policy. The Federal Reserve, in response to higher inflation, raised interest rates to keep the inflationary pressure under control. This led to monetary policy becoming less accommodative. The European Central Bank, ECB, has a singular mandate of maintaining price stability, and it predominantly employs interest rates as its key instrument to accomplish this. Established in 1998, the ECB is the central bank for 27 European Union countries, which have adopted the euro. Its main function is to maintain price stability in the euro area, thereby preserving the purchasing power of the single currency. To fully appreciate the ECB's efforts, it's important to understand the concept behind monetary policy. Monetary policy refers to the actions undertaken by a nation's central bank to control money supply and achieve goals that promote sustainable economic growth. It uses a variety of tools to control outcomes like economic growth, inflation, exchange rates with other currencies, and unemployment. Now, for several years, the ECB has been wrestling with the challenge of low inflation. This scenario is when the general level of prices for goods and services isn't rising as planned or even falling outright, which can be a problem for economies. Low inflation can lead to increased unemployment and slowed economic growth, something the ECB is mandated to avoid. The bank even resorted to an unconventional policy of negative interest rates. Negative interest rates are an extraordinary measure that central banks implement during deflationary periods when inflation is too low. Essentially, this means banks and other financial entities are required to pay to keep their excess reserves stored at the ECB, thereby encouraging banks to lend more to businesses and consumers, stimulating economic activity. However, as the European recovers from the devastating effects of the pandemic, inflation took an upward turn. This is primarily because economic recovery often leads to increased demand for goods and services, which can then drive up prices. This triggered a significant shift in the ECB's monetary policy, requiring the bank to adjust its strategies to maintain price stability. This involved raising interest rates, reducing money supply, or other measures that the bank deems fit to control inflationary trends. This represents a remarkable transformation in the economic and monetary policies of the European Central Bank. The Bank of England, much like its American counterpart, the Federal Reserve, operates under a dual mandate, which entails maintaining stability in the financial system and promoting economic growth. This essentially means implementing measures to control inflation and support employment. However, it has been markedly more aggressive in employing the tool of quantitative easing to stimulate economic activity. While most central banks worldwide have used quantitative easing in some form or another, especially during periods of severe economic downturn, the Bank of England has been relatively assertive in implementing this measure. Quantitative easing essentially involves the purchase of government bonds and other financial assets to increase the money supply, lower interest rates, and encourage lending and investment. This unconventional monetary policy tool has been a key policy of the Bank of England's strategy to boost growth and combat the economic downturn. Quantitative easing has had a significant impact on the UK economy, particularly on inflation. The UK has experienced higher inflation rates than both the United States and the Eurozone in recent years. This situation has unfolded due to a variety of factors, including the depreciation of the British pound, fluctuations in commodity prices, and changes in the global economy. Despite the adverse effects of higher inflation, such as a reduction in purchasing power and increased production costs, it has also contributed to stimulating economic activity by encouraging spending. However, the trend of high inflation is expected to persist in the coming years, implying a continued shift in the Bank of England's monetary policy. Persistently high inflation levels prompted the bank to tighten its monetary policy to stabilize the economy. This situation could unfold in a number of ways, including the Bank of England maintaining interest rates to control inflation and curtailing its bond purchases to reduce the money supply. Consequently, the macroeconomic landscape of the UK has witnessed significant changes, driven by the Bank of England's monetary policy decisions. Business decisions, consumer behaviour, and the property market, among other sectors, are impacted by these changes. The Bank of Canada also has a dual mandate, but it has been more conservative in its use of monetary policy tools. This conservative approach to economic regulation has roots going back to the early inception of the bank itself. It has always prioritized stability above all, laying down a safety net for the country's economy. This trait has been visible throughout the decades, with the bank maintaining a steady hand on the rudder, even amidst global economic upheavals. Canada's economy, much like others worldwide, operates under the forces of supply and demand. These forces are impacted by various factors like geopolitical events, technological advancements, domestic policies, and even natural disasters. To manage these forces and maintain price stability, a country's central bank uses monetary policy tools. However, Bank of Canada's conservative approach means it has been more thoughtful and measured in the deployment of these tools. Instead of a knee-jerk reaction to shifts in the market, it has often opted for a patient, wait-and-see approach. This doesn't mean that the bank is unresponsive or unwilling to act. Instead, it's an indication of its commitment to long-term stability over short-term gains. However, as the Canadian economy recovers from the pandemic, inflation levels have risen. This led to a change in the overall economic environment, and by extension, the Bank of Canada's monetary policy. The inflationary spike prompted the bank to adjust its interest rate policies to keep inflation within a manageable range. This impacted various sectors, from housing to investments, leading to a change in the Bank of Canada's monetary policy. In summary, current monetary policy and inflation trends in North American and Western European economies will likely continue in 2024. The Federal Reserve, the ECB, the Bank of England, and the Bank of Canada could all potentially tighten monetary policy further to keep inflation in check. However, the extent and timing of these changes will depend on a variety of factors, including local economic recovery and global economic conditions. The only certainty is that the years ahead will be full of interesting developments for economists and policymakers alike. Central banks will likely remain hawkish until the end of 2024 or early 2025.